Hello guys, good day. Welcome to another video lecture in ACC 221 Intermediate Accounting 3. In this video lecture, we will be discussing about one of the components of your financial statements, which is your statement of financial position. So, our class objectives in discussing this particular topic is at the end of this lecture, we should be able to understand and know the nature of a statement of financial position, to understand the current and non-current classification of both assets and liabilities, and at the same time to identify the different components of an equity for a corporation, and lastly to identify the minimum line items in preparing for a statement of financial position. So to start our discussion with this topic, let us discuss first the concept of your statement of financial position. So as what I have mentioned earlier, that your statement of financial position is one of the five complete components of your financial statement. So statement of financial position is a formal statement showing the three elements comprising your financial position, namely your assets, liabilities, and your equities. All right. So, needless to say, when we talk about assets, these are the properties that are owned by the entity or a particular organization. In this case, properties that are owned by a corporation. Liabilities, on the other hand, these are the obligations, these are the debts that are required to be paid by the corporation for a specific period of time. And your equity, it is the residual component of an entity over its liabilities. So investors and creditors, as well as other statement users, analyze the statement of financial position to evaluate such factors as liquidity, solvency, and the need of the entity for additional financing. So primarily, financial statements, specifically, your statement of financial position, is a very good tool for the different stakeholders or for the different decision makers in assessing their decisions or in creating their decisions. For example, for our potential investors will assess first the level of or the status of the corporation based on its financial position through assessing its liquidity or solvency before they could entrust their resources or their investments into this type of corporation. So obviously guys, when this corporation or when corporation has not so good statement of financial position, or let us say there are deficit in the face of the statement of financial position, then obviously it is a red flag on the eyes of the different stakeholders, particularly our potential investors, whether or not to invest their money in these types of corporation. So usually, this statement of financial position reports as to the level of the assets over its liabilities and equity of a particular corporation. As well as in terms of creditors, so let us say creditors will not just simply grant loan application by different corporation applicants before assessing their financial statements first, because obviously these credit unions or financial institutions will only allow when a particular corporation meets the minimum requirements set by a particular financial institution or lending institution. So if ever the profitability ratio or a specific ratio of a particular corporation is not met by a particular corporation also, so therefore they will not grant that specific loan application. So that assessment can be considered through the use of your statement of financial position. Information about priorities and payment requirements of existing claims can help users predict how future cash flows will be distributed among those with a claim against the entity. In other words, information about liquidity And solvency is useful in predicting the ability of the entity to comply with its future financial commitments. So in this case, statement of financial position is really a very good tool, not just by the internal party but also for external parties for their respective consumption, whether for assessment for additional financing or assessment for possible grant of loan or possible investment opportunity for potential investors. Now, in terms of your statement of financial position, as mentioned earlier, it reports about the assets, liabilities, and owner's equity of the entity. No? The standard PAS 1 paragraph 60 provides that an entity shall present current and non-current assets and current and non-current liabilities as a separate classification in the statement of financial position. So it is expected that liabilities and assets will be divided into two, the ones which are current and the other ones are for non-current liabilities. However, an entity shall present all assets and liabilities in order of liquidity when such presentation provides information that is faithfully represented and more relevant. The standard suggests that when an entity prepares financial statement, particularly statement of financial position, assets and liabilities will be chronologically arranged based on their level ng liquidity. So that means your assets um, will be reported in your statement of financial position based on their level of liquidity, meaning the level of such asset to be converted into cash. So that means first line in the asset portion of your statement of financial position will be your cash and cash equivalents up to the not so liquid type of assets. Same will be applied for your non same will be applied for your liabilities. So when an entity supplies goods or services within a clearly identifiable operating cycle, the separation, classification of current and non-current assets and liabilities is useful information by distinguishing between net assets that are continuously circulating as working capital from the net assets used in long-term operations. All right? So, we already have an idea this time that both their assets and liabilities will be reported separately. But this time, let us specifically address these three special components of your statement of financial position. To start, we have these assets. So, assets, as mentioned earlier, are defined as resources controlled by the entity as a result of past transactions and events from which future economic benefits are expected to flow to the entity. In short, in layman's language, assets are properties that is owned by a particular entity. So there are essential characteristics of an asset, namely, the asset should be controlled by the entity. So obviously, there is control for a particular asset. So take note, guys, that control and take note that control and custody is two different words. It doesn't mean that you have the custody of an asset, you already have the control over that. All right? So, before an asset or before an item be considered and recognized as an asset of an entity, the entity should have control over that property. And such asset is the result of a past transaction or event. So, meaning, um, maybe it can be from a sale transaction or an exchange transaction from the past. All right. And letter C, the asset provides a future economic benefit. And lastly, the cost of the asset can be measured reliably. So obviously, based on the recognition principle of an asset, such asset should have or should be recorded at cost, no? And the cost of it should be measured reliably. Okay, so speaking of assets, these assets are divided into two types. So as mentioned earlier, your assets will be reported with whether current or non-current assets. The standard actually provides, guys, that an entity shall classify an asset as current when letter A, the asset is cash or cash equivalents unless that asset is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting period. So generally, all your cash and cash equivalents are considered as current assets. However, for example, a cash is considered as a sinking fund for the settlement of a long-term maturing obligation or your bonds payable. So in that case, such cash, since it is associated and linked to a non-current liability, therefore, it will also be categorized as a non-current asset, regardless if it is cash or cash equivalent. But if it's just simply general cash or cash equivalent, then therefore automatic it will be considered as a current asset. Another, when the entity holds the asset primarily for the purpose of trading. So when the asset is considered as an inventory of an entity, then therefore it shall be considered as a current asset. For example, we have real estate as an inventory. So obviously, in form, it might look like a property or non-current asset, but in substance, it is actually an inventory, and thus inventory are considered as non as is considered as current assets. So therefore, um, properties like house and lot which are for sale, parcel of land which are held for sale are all considered as current assets. Letter C, the entity expects to realize the asset within 12 months after the reporting period. Or, example for these are those accounts receivable which are expected to be collected for 1 year or for less than 12 months period. And lastly, guys, an asset will be recognized as a current asset when the entity expects to realize the assets or intends to sell or consume it within the entity's normal operating cycle. So, to sum up, the nature of a current asset includes number one, cash and cash equivalents. Number two, as long as it is held for trading regardless of its form, it will be considered as a current asset as well. And lastly, those are expected to be realized within 12 months. So to easily understand and to conceptualize current asset, you just simply need to remember these three current asset natures. Number one, cash and cash equivalents. Number two, held for trading. And number three, expected to be realized within 12-month period. All right? So again, the presentation of your current assets are usually listed in the statement of financial position in order of liquidity. So as what I have mentioned earlier, guys, that the assets, the line items of your assets will be chronologically arranged based on the order of liquidity. So example, it will start at cash and cash equivalents, followed by financial assets at fair value such as trading securities and other investments in quoted equity instruments, followed by trade and other receivables, inventories, and prepaid expenses for the presentation of your current assets. Now, this time, let us proceed with your non-current assets. Actually, guys, the standard states that an entity shall classify all other assets as current, not classified as current, as non-current assets. In short, non-current assets has a residual definition over your current assets. That means all other assets which are not considered as current assets will be classified as a non-current assets. In other words, again, all other items which are not under current assets will be considered as a non-current assets. Accordingly, your non-current assets include the following. Letter A, PPE, property, plant, and equipment. So this time, in form and in substance, these PPE are really non-current assets. No? Unlike earlier, when these PPE are held for sale, This PPE will now be classified as a current asset since it follows held for trading. But this time, all other property, plant, and equipment, as long as it is intended to be used in the operation of the entity, then therefore it will be considered as a non-current asset. Letter B, long-term investments, intangible assets, and all other non-current assets will comprise your non-current asset component in your statement of financial position. Okay? So another is your liability. Okay? So liability, these are defined as the present obligation of an entity arising from past transactions or events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. As mentioned, liabilities is expected to be settled, and when that settlement occurs, that will again reduce the economic benefit of an entity, whether it is on cash or other non-cash assets. So essential characteristics of a liability are as follows. Letter A, the liability is a present obligation of a particular entity. All right? And this liability arises from past transaction. It is always considered that there will no liability to be recognized when the cause of it is to happen pa in the future. Liability will only arise from past transactions of an entity. And the settlement of the liability requires an outflow of resources embodying economic benefits. So obviously, when the time comes that you will be settling your liabilities, there is obviously a decrease in your economic resources, whether as what I have said, whether it's on cash or non-cash assets. Okay? So also, liabilities are divided into two, just like your assets, liabilities which are current, and liabilities which are non-current. The standard, past one, provides that an entity shall classify a liability as current when, letter A, the entity expects to settle the liability within the entity's normal operating cycle. Letter B, when the entity holds the liability primarily for the purpose of trading. Letter C, the liability is due to be settled within 12 months after the reporting period. Or letter D, the entity does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. Any of these circumstances would result a liability to be classified as a current one. Alright? Now, we have several examples of current liabilities. Current liabilities includes number one, trade payables and accruals for employee and other operating costs. Another, obligation that are not settled as part of the normal operating cycle but are due for settlement within 12 months after the end of the reporting period. And your financial liabilities held for trading will also be considered as financial liabilities that are incurred with an intention to repurchase them in the near term. All right? So these current liabilities also to be reported in a chronological order based on liquidity, no? Based on current liability, no? The standard provides that as minimum, the face of statement of financial position shall include the following line items for current liabilities. So, in minimum, your statement of financial position should include trade and other payables, current provisions, short-term borrowing, current portion of a long-term debt, and current tax liability. So what is the example of the current portion of a long-term debt? For example, bonds payable. This bonds payable is a term bonds payable or yung series, sorry, series na bonds payable. That means every year, portion of that bonds payable will be maturing. So the the maturing part of that bonds payable will be considered as the current portion of a long-term debt. Okay? Also, same with your assets, we also have non-current liabilities. So non-current liabilities are those liabilities which are not classified as current. No, same. It follows a residual definition over your current liabilities. So examples of your non-current liabilities include letter A, non-current portion of a long-term debt, finance lease liability, deferred tax liability, long-term obligation to entity officers, and long-term deferred revenue. Okay? Now, this time, let's proceed with the third component, which is your shareholders' equity. Okay? Shareholders' equity, it is the residual interest of the owners in the net assets of a corporation measured by the excess of assets over your liabilities. So, common components of your SHE includes share capital, which is the portion of the paid-in capital representing the total par or stated value of the shares issued. The subscribed share capital, that includes the portion of the authorized share capital that has been subscribed but not yet fully paid and therefore still unissued, and subscription receivable, which are preferably be reflected as a deduction from the related subscribed share capital, and your share premium, which is the capital contributed by the shareholders in excess of the par or stated value of the shares subscribed and issued. So I know that, guys, that these are not new for you because you have discussed it already in your intermediate accounting 2. So our purpose, aside from those items, guys, before we proceed with the presentation in your statement of financial position, we also have this so-called retained earnings. So these retained earnings or the accumulated earnings or accumulated losses, it is the amount of earnings accumulated from previous periods. Retained earnings increase by the amount of net income for a period and decrease an account of dividend payments and restatement if there's any. So as what I have mentioned, retained earnings, it is where we lump all the previous losses and previous earnings of the entity. It might be or it may be affected by a net income, a net loss, prior period errors, and dividend payment, because dividend payment to the shareholders will be coming from your retained earnings. Okay? So retained earnings at the start of a period plus net income for the period minus dividend paid plus minus restatement on account of accounting policy changes or errors is equal to retained earnings at the end of the period. So aside from the capital, your shareholders equity will also report you about the retained earnings of an entity. All right. So these are the sample line items that should be reflected in the face of your statement of financial position. Pass 1, paragraph 54 states that as a minimum, the statement of financial position shall include the following line items. So we have there your cash and cash equivalents, financial assets, trade and other receivables, inventories, property, plant and equipment, investment in associates over equity method, intangible assets, investment property, biological assets, and the likes up to the equity portion, which includes your share capital and your reserves. Okay? So again, just a reminder that the listing of the line items is not exclusive. So the judgment on whether additional line items are presented separately is based on the assessment of the following. Letter A, nature and liquidity of assets, function of assets within the entity, and the amount, nature, timing of liabilities. Okay? So paragraph 54 simply provides that a list of items that are sufficiently different in nature and function to warrant separate presentation on the face of the financial position. The standard reiterated that additional line items, headings, and subtotals shall be presented on the face of the statement of financial position when such presentation is relevant to the understanding of the financial position of an entity. Okay? So it is the prerogative of the entity whether or not to abide with the minimum items to be reflected in the statement of financial position. But again, it is the judgment of the management or the accountant whether to add more relevant line item in the financial position. Okay? So speaking of statement of financial position, the format of a statement of financial position is actually not specified in the standard. No, there is no specified format according to the standard. However, in practice, there are two customary forms in presenting the statement of financial position, namely the report form and the account form. So report form, this form sets forth the three major sections in a downward sequence of assets, liabilities, and equity. Okay, so you simply line it down at the top. At the top you have your assets followed by your liabilities, and then at the end you have your equity portion. While your account form, as the title suggests, the presentation follows that of an account, meaning the assets are shown in the life on the left side and the liabilities and equity on the right side of the statement of financial position. All right? So later on, we'll have sample format of your statement of financial position, both for report and account form. But to continue further the discussion of statement of financial position, the statement of financial position is an expansion of the accounting equation. Asset is equal to liabilities plus owner's equity. So that means your statement of financial position should be able to report about your asset, liabilities, and owner's equity. And again, just like your basic accounting equation, all of your assets should also be equal to the sum of your liabilities and owner's equity. Okay? So the standard provides that there is no prescribed order or format in which line items are to be presented. Okay? The standard also has not provided as to the the manner on how are we going to present every line item in the statement of financial position. But in the Philippines, the common practice is to present in the statement of financial position current assets before non-current assets, current liabilities before non-current liabilities, and equity after liabilities. All right, that is only the customary form in the Philippines. But actually, in other countries, there are some formats which is actually not in accordance with what is being practiced here in the Philippines. So even in other countries, they report first their non-current asset followed by current, and non-current liability followed by current liability, and then your equity portion. All right? So other formats may be equally appropriate provided that distinction is clear in accordance with paragraph 7 of the preface to IAS 1. Note that the format of the statement of financial position as illustrated in the appendix IAS 1 is in the following order. So sabi ko na nga guys, the just like what is practiced in United Kingdom, they present their financial position components. Number one, first non-current assets followed by current assets to be followed by equity, non-current liabilities, and your current liabilities. Pero again, for your information, in the Philippines, all right, we report, all right, just like example, under report form, as mentioned earlier, report form follows the sequence of your asset, liability, and owner's equity. Okay, so we have the assets at the top, we have the liability and shareholders equity at the bottom. Okay, in this case, all of your assets are arranged based on their liquidity. So current assets are reported first to be followed by non-current assets. Same with your liabilities. Your liabilities are also reported first for current liabilities followed by non-current liabilities, and then to be followed by your shareholders equity. Okay? So in this case, every line item encompasses a note. All right. For example, cash and cash equivalent, note 1. So the details of this cash and cash equivalent can be located in the notes to financial statements 1. All right. So meaning these reports of your assets in your statement of financial position are already the aggregate of the total items which are lumped in the single line item. So that means, for example, in your cash and cash equivalents, this 500,000 is already the total of all your items which can be lumped in your cash and cash equivalents. So for example, what are the items under cash and equivalents? So let us say we have your cash on hand, cash and bank, petty cash fund, treasury bill, and the likes. All right. So that means the total items of those accounts are 500,000. All right. And so on and so forth. Okay. So this is actually an example of a statement of financial position under report form. So it's actually from the book of Valix, Peralta, and Valix. Okay? So ano guys, si report form, yun nga. Straight lang siya, sequence format, asset, liabilities, and then owner's equity. And then we also have here your account form. As mentioned, your account form, on the left side, your assets and your liabilities and equity on the right side. So still, your assets are being reported separately, one for current and another is for non-current assets. So as mentioned, always that your assets will be equal to the sum of your liabilities and equity account. Okay? So we have here sample question for this particular video lecture. So let us check whether who among you guys can go up to this specific portion of the video lecture. So please answer this particular sample question and comment down below your suggested answer. All right. So let us see who among you has really made time to watch this video lecture. So we have Violago. Company provided the following account balances at year end. So it has accounts receivable, financial assets at fair value through profit or loss, financial asset at amortized cost, cash, inventory, equipment and furniture, accumulated depreciation, patent, prepaid expenses, and equipment that's held for sale. So question, what amount should be reported as current asset at year end? So kindly comment down below your answer. So this question will test your ability to identify uh, titles or account titles which are to be classified as current or non-current one. All right? So let's check uh, later on. Okay? So that's it for our lecture for statement of financial position. So if you have any more concerns, violent reacts, or additional inputs, please reserve it and address it. We will address that during our virtual class. So again, the sources of this material are from these books and authors. So thank you very much for your time and God bless.